Hello, good evening. My name is David. I'm here with my colleague Alex. Good evening, people. We're going to help you tonight in this webinar to understand the basics of how to trade on Forex and to present you our trading platform. Also, we are going to present you one of the market opportunities that we have right now. So, for the beginning, we are going to start with risk warning. When you are trading with CFDs and other leverage products, that carries a high level of risk to your capital as the price may move rapidly against you. So be aware you can lose all, but not more than the balance of your trading account. These products may not be suitable for all clients. Therefore, ensure you understand the risk and seek independent advice. This material does not constitute an offer or of solicitation for a transaction in any financial instrument. Trade accepts no responsibility for any use that may be made of the information and or for any consequence that result. No representation of warranty is given as to the accuracy or competencies of the informations. Consequently, any person acting on it does so entirely at their own risk. Basically, you are going to make your own decisions when it comes to a trade. Okay, so tonight the context of this webinar it's going to have few points. First of all, what is Forex? Then how does it work? Trading hours of Forex market, Forex technical terminology and their meanings, why trade Forex markets, benefits of trading Forex markets over other financial markets, important tips that help you trade Forex.
Okay. What is Forex, Kolega?
So, Forex is a part of the financial market which offers a wide range of financial instruments to trade on in the form of derivatives. These include Forex currencies, CFDs on gold, crude oil, indices, and shares. Daily trading volume surpasses 5 trillion US dollars, and it is considered the largest financial market in the world. Financial leverage can amplify the possibility of earning money quickly, but it can also give you a quick, larger losses too.
Okay, let's simplify this. So let's say just for an example, if you ever travel to another country, you usually had to find a currency exchange booth at the airport and then exchange the money you have in your wallet into the currency of the country you're visiting. You go up into the counter and notice a screen displaying different exchange rates for different currencies. You find that your £1 is worth 138 Japanese yen, and you have £10, and you're exchanging them for the Japanese yen. When you do this, you essentially participated in the Forex market. You've changed in one currency for another. Or in Forex trading terms, assuming you're an American visiting Japan, you sold dollars and bought yens. Before you fly back home, you stop by the currency exchange booth to exchange the yen that you miraculously have left over and notice the exchange rate have changed. It's these changes in the exchange rates that allow you to make money in the Forex exchange market. The Forex exchange market, which is usually known as Forex or FX, is the largest financial market in the world. It is over the counter market in which the foreign currencies of the world trade and also other products such as stocks, indices, commodities, and agricultural products. And these are called in the Forex language CFDs, which means that CFD or contract for difference is a financial instrument that allows trades to invest into an asset class without actually owning the asset. The CFD is a contract between two parties, the buyer and the seller, meaning that we are trading only with the price of that financial instrument, which gives us the benefit to sell without owning anything. Compared to the measly 7.2 billion per day volume of the London Stock Exchange, the foreign exchange market looks absolutely enormous with its 5.3 trillion a day trade volume. So as we can see, the Forex market is the most liquid market. Mr. David?
Okay, let's continue. So we are going to explain you how the Forex market is working. First of all, you can trade Forex 24 hours a day, 5 days a week. Forex markets do not compete with the rest of the financial markets. Other markets have a predetermined opening and closing time with a short time frame. Forex markets offer the freedom to trade at any time during the week except weekends.
In in rough translation, forex exchange has no centralized market. Instead, a forex exchange market exists wherever the trade of two foreign currencies are taking place. It is open 24 hours a day, 5 days a week. This foreign exchange market exists to ease the trade. The primary trading centers are London, New York, Tokyo, and Sydney. That's why it works 24 hours a day. All level of trade from central banks to speculators and retail traders, that's us, and trade currencies and other CAD products with one another.
Okay, so we are going to explain what is a currency pair now. A currency pair is the value of one currency expressed in terms of another currency. In other words, a currency pairs represents the comparison of one currency with another, as you can see here in the example of euro and USD dollar. In this equation, the numerator represents the sell price, the price at which 1 euro can be sold to the market maker, whereas the denominator represents the buy price, the price at which 1 euro can be bought from the market maker. The difference between the two is referred to as a spread and represents the amount retained by one bank or brokerage firm for the efforts that these institutions put forth in order to make certain transactions available. In our example, the spread is equal to 3 pips or 3 units of the fourth decimal.
Okay, let's simplify this. It's simply because you're not buying anything physical. Forex trading, it's a little bit specific. Think of buying a currency as buying a share in a particular country, kind of like buying stocks of a company. The price of the currency is usually a direct reflection of the market's opinion on the current and future health of its respective economy. In forex trading, when you buy, say, the Japanese yen, you're basically buying a share in the Japanese economy. You're thinking that Japanese economy is doing well and will even get better as time goes. Uh, let's say, for example, once you sell those shares back to the market, hopefully you will end up with a profit. In general, the exchange rate of a currency versus other currency is a reflection of the condition of that country's economy compared to other countries' economies. Forex trading is simultaneously buying one currency and selling another. Currency are traded through a broker, like us for trade, or a dealer, and are traded in pairs. For an example, the euro versus the US dollar, or the British pound versus the Japanese yen. When you trade in the Forex market, you buy or sell in currency pairs. Imagine like each currency pair, it's constantly in a tug of war, which each currency on its own side of the rope. Exchange rate fluctuate based on which currency is stronger at the moment.
Okay. The most popular currency pairs are euro to US dollar, then pound sterling to US dollar to Japanese yen, US dollar to Swiss franc, US dollar to Canadian dollar, Australian dollar to US dollar, euro to pound sterling, euro to Japanese yen, and also euro to Swiss franc.
Okay, let's say for an example, let's take the Euro USD. In this example, the euro is the base currency and thus the basis for the selling or buying. If you believe that the US economy will continue to weaken, which is bad for the US dollar, you will execute a buy Euro USD order. By doing so, you have bought euros in expectation that they will rise versus the US dollar. If you believe the opposite, that the US economy is strong and the euro will weaken against the US dollar, you will execute a sell your US dollar. By doing so, you have sold euros in expectation that they will fall versus the US dollar. Or let's take the example of Great British Pound with the USD. In this example, the pound is the base currency and thus the basis for the buying or selling. If you think that the British economy will continue to do better than the US in terms of economic growth, you would execute a buy British pound versus USD order. By doing so, you have bought pounds in expectation that they will rise versus the US dollar. And if you think the opposite, that the British economy is slowing while the United States economy remains strong, you will execute a sell dollar on this currency pair. By doing so, you have sold pounds in the expectation that they will depreciate against the US dollar, and so on and so forth.
Okay, right now we are going to explain to you what is a spread. The difference between buy and sell price is called a spread, as you can see on the screen.
So, spread is, like my colleague said, is the difference between the prices. Hey, let's say if for an instance you want to convert US dollar to the euro at the bank, they will tell you that their buying price is 1.56 and the selling price is 1.59. In other words, in order to buy euro, you will have to pay a little more than $1.5 US. If in that very moment you want to sell your €1 to the bank will buy €1 at a price slightly lower than 1.5 USD. So you sold so if you sold 1,000 US dollars to the bank, you receive 641 euros. By selling the euro back, you will get only 955 US dollars. So you paid 1,000 US dollars and you received 955. And where are the other 45? That's the profit of the change store, and this is the commission they charge for their customer. This is the only commission that you will pay in the Forex market, and there are no additional costs.
Okay, spread is correlated with the pips. So pips, as you can see in the screen, if you are looking at this currency pair, euro to US dollars, it equals right now 1.4745. And if it moves up to 1.4746, that means the price has changed by 1 pip.
Or in other words, the uniform measure to express the change in value between two currencies is called a pip. Most pairs go out to 4 decimal places, but there are some exceptions, like the Japanese yen pair. They go only to 2 decimal places. Moving on.
Thank you, Alex. We are going to explain you now what is leverage. Leverage gives clients the opportunity to use a small amount of invested money to perform a higher volume of trading transactions. The typical leverage ratios range from 1:1 to 500:1. When you are trading with currency pairs, the most frequently offered leverage is 200:1. Example, let's assume that you made an initial deposit of 500 US dollars and that you can use leverage up to 200:1. This means that with 500 US dollars in your equity, you have the ability to perform a trade equivalent to 100,000 US dollars.
But let's not forget to mention that without a proper risk management, the high degree of leverage can lead to large losses as well as gains. Basically, it's a double-edged sword. It can work with you, but it can also work against you. That's why proper risk management is always strongly advised.
Okay, why to trade on the Forex markets? There are a couple of reasons. First of all, extremely high liquidity. There is always the possibility to enter or exit a trade.
Because the Forex market is so enormous, it is also extremely liquid. This is an advantage because it means that under normal market conditions, with a click of a mouse, you can instantaneously buy and sell at will, as there will usually be someone in the market willing to take from the other side to take your trade. You're never stuck in a trade. You can even set your online trading platform to automatically close your positions once your desired profit level, a limit order, has been reached, and or close a trade if the trade is going in against you. a stop loss order.
Thank you, Alex.
Welcome.
There are also no explicit commissions except for the spread between the buy and sell.
So no clearing fees, no exchange fees, no government fees, no brokerage fees.
Of course, there are also low barriers to entry.
Okay, what that does mean, yeah, that if you think that getting started as a currency trader would cost you a ton of money, the fact is, when compared to trading stocks, options, futures, it doesn't. Only forex brokers offer mini or micro trading accounts, some with a minimum account deposit of 100 pounds or dollars. We're not saying you should open an account with the bare minimum, but it does make forex trading much more accessible to the average individual who doesn't have a lot to start up with a trading capital. Also, it's a 24-hour market. There is no waiting for the opening bell. From Monday morning opening in Australia to the afternoon closing in New York, the forex market never sleeps. This is awesome for those who want to trade on a part-time basis because you can choose when you want to trade, morning, noon, night. So at any time and also from anywhere, simply by using internet with your tablet, computer, or mobile, you will have full access to the market.
Thank you, Alex. Like my colleague says, so it's easy access to the market anywhere, anytime. Managing and tracking price movement is very simple. Also, free education and information about the market.
We offer demo account to practice trading and to build your skills, along with real-time forex news and charting services. Demo accounts are very valuable resources for those who are financially hampered and would like to hone their trading skills with play money before opening live trading account and risking real money.
Okay, we are going to take a closer look to Forex and to other stock markets. So, in stock trading, traders can gain from rises in the value of the stock, but not when these fall. For example, when you buy shares on Wall Street, this increases your options that you can buy, while your option in the case of a fall in a value, you cannot sell. However, in the Forex market, you can earn from both increases and decreases in prices by opening either a buy long position or sell short position.
Thank you, David. That was nice. Moving on.
So, how do you make a correct trading assessment? That's crucial, Alex.
Of course. We have fundamental analysts, technical analysts, and also after that, we're going to cover using indicators with our trading platform online.
So fundamental analysis examines the macroeconomic factors that influence the state of the economy, industrial sectors or specific companies and their market shares. So you can see in the screen a couple of those that are usually tracked. Those are jobless claims, unemployment rate, manufacturing price index, GDP, interest rates, etc., etc.
So the idea behind this type of analysis is that if a country's current or future economic outlook is good, their currency should strengthen. The better shape of a country economy is, the more foreign businesses and investors will invest in that country. This results in the need to purchase that country's currency to obtain those assets. Let's say, for an example, that the US dollar has been gaining strength because the US economy is improving. As the economy gets better, raising interest rates, like we had it over here on the slide, interest rate, that's a fundamental indicator. Raising interest rate may be needed to control growth and inflation. Higher interest rate make dollar-denominated financial assets more attractively. In order to get their hands on these assets, traders and investors have to buy some dollar first. As a result, the value of the dollar will likely increase.
Okay, another very important part when you're trading is technical analysis. In the market, there are certain factors that should be taken into consideration. Prices usually move in one direction or the other according to market trends, market reacts similarly under the same conditions, and history intends to repeat itself.
So what that does mean is technical analysis is the framework in which Forex trades study price movement. The theory is that a person can look at historical price movement and determine the current trading condition and potential price movement. The main evidence for using technical analysis is that theoretically all current market information is reflected in price. If price reflects all information that is out there, then price action is all one would really need to make a trade. Now, everybody knows about history tends to repeat itself. Well, the basicality, what technical analysis is all about is that if a price level held as a key support or resistance in the past, trades will keep an eye out for it and base their trades around the historical price level. Technical analysis look for similar patterns that have formed in the past and will form trade ideas, believing that that price will act in the same way that it did before.
Technical indicators obtained using mathematical formulas for historical prices of financial instruments, like my colleague Alex said. There are dozens of technical indicators that trader can use. We are going to right now go to our site. And we are going to explain you in the basics how our platform is working and to explain you how you can trade. So, first of all, you have two modes, two types of the account. That's practice mode and that's real mode. Right now, we are at our practice mode. You can see here in the top left-hand corner your account balance. You can see the open profit and losses on your positions, and of course you can see your equity. When we open position later on, you will see here in this part, financial strength, basically how your position is going. Is it safe or risky trading? Okay. So when you are trading, what you need to know is few of the basics. First of all, you need to know how to find the instruments that you want to trade with. In the left middle side of the screen, you have here, if you click in the option all instruments that you can trade with. Those are currencies, indices, stocks, commodities, also US treasuries, etc. Let's say that right now we are interested to take a look at the currency pairs, and we will check the major currency pairs like euro to US dollar. You found this particular instrument, and what you need to do is simply to click on it, and now you have a graphic on the right middle side of the screen that is showing you how the price of this instrument is moving.
Okay, thank you, David. So as we said, technical indicators, and we said about the graphic. This is a graphic shown of Euro versus USD. So basically, before we want to open a position, we need to know what are we looking at. This is, as we can see, this is a time frame of 30 minutes, meaning that it's showing the price movement in the last 30 minutes. The name of this graph particularly is candlestick. You can also put it on line, but it's strongly recommended to be on Japanese candlestick because it's a more efficient and more better view. The red candlestick, which indicates a growth of this currency pair financial market, we can see it here, and the red one indicates a slight down on this financial instrument. So when we want to, as we said, technical indicators, basically technical indicators are helping us to have a better view of this graph. We can find them right at this button, and we have moving average converged diverged, or short MACD, Bollinger Bands, RSI, stochastics, and many more. I, for one, always favor the stochastic because it's the most easiest one. In this part, we can see it's made of two lines, 20 and 80. Stochastic is basically oscillator between the price. If these two moving averages are above 80, that indicates that this financial instrument is overbought, and we can assume or expect in the near future is gonna be a fall down, and we're gonna open a sell position. If the opposite happens, if it goes down beneath 20, we can expect that in the near future we're gonna have a growth, and we can go in a buy position.
Okay, so now we are going to open a position on this instrument. What you need to do when you want to trade is to make a decision. Do you want to go into sell or into buy position? And when you have that, what simply you're going to do is to click either on a sell button or on a buy button. Let's, for example, say that we're expecting this currency pair to the price to go down. So we are going to click on the sell button, and the new window is appearing. As we mentioned before, we have here a leverage. So the minimum amount that you can trade when you are trading with this currency pair is 1,000. The very important thing that I'm going to explain you right now are two parameters that you're going to use when you're trading, that is stop loss and take profit. You can find them here in advanced features. Just click on it. And let's explain a little bit. So we opened a sell position. We are expecting for the price to go down. That means that we are not going to look forward for the rise in this price. So current rate that we are opening this position is 1.07241. So in case if the price is going to move up opposite or on what we expected, you can put a stop loss. So you just click on the stop loss, and there is already there some price that is put. But as I said, we expect the price to go down, not up. So if that happens, we are putting a safety. So we are going to put this stop loss a little above this current rate. Let's say it is going to be 1.07355.
So basically what you're saying, David, I'm just willing to, even if I want to invest, let's say for example, 1,000 British pound, I can limit my losses to just £1 and 15 cents, right?
Exactly. That is this is a very important thing with your trading, because using this, you can put the risk when you're trading to a minimum. Basically, you are putting yourself a limit on how much money do you want to risk in any particular trade.
And this is a risk management, right?
Of course, this is a risk management.
Thank
you. Same goes with the take profit. So we open the sell position, so we are expecting for the price to go down. So the take profit, logically, should be under this current rate. And of course, Alex, the bigger the difference is, the bigger the profit we are going to gain.
The bigger the potential profit, right?
Yeah, the bigger the potential profit is going to be. Okay. So let's say that we want to put this take profit at this level, 1.06500. Okay. So that means that when the price of this instrument reaches this level, we are going to have a potential profit of $7.
And also, this is a proper money management, because we cannot put stop loss bigger than the potential profit. It's not logical to lose $5 in order to gain 3. Am I right?
Of course.
Okay. So what are you gonna do now?
Just click on that sell button, and your position is ready. You can see your position in the left side of the screen, lower left hand side of the screen, right here, you can see the instrument that you opened. You can see the position that you opened, the open price, time, uh, stop loss and take profit that you put in, etc., etc. Right now, as I mentioned before, you have in the upper left-hand corner account balance, open, profit and loss, and equity. Our account balance before we opened this trade was 9.999 thousand US dollars. Right now, our open position is in a bit of a loss. It's 0.18 cents.
And as we said, that was the spread, right? That the commission the brokers are charging for.
Of course, of course. So, very important thing for you to have when you are trading is the financial strength. As you can see, those bars are right now completely filled. So that means that our open position is very good and it's not risky trading. Alex?
Thank you very much, my dear colleague. Thank you very much. So let's say, for an example, at any time my position is going the wrong way or the preferred way, I just want to close my position. I don't want to watch it anymore, or I don't want to wait for the take profit level. I simply just click on close trade, and that's about it. That's about it. And from now on, we're gonna move to the market opportunity. That's why, because yes, we mentioned before, Forex is a 24-hour market, works 5 days a week, but we cannot simply open a trade in any time given. Wake up 3 o'clock in the morning and open it, right?
Of course, you need to have the information, you need to have the analysis.
Thank you very much. That's what we call market opportunities, and this is the one of them that we had today. It's about GDP in the U.S. economy. It was one of the most important ones, and what we have here is market opportunity with potential profits or losses, and this is how it looks. About the pivot points, those are the if you remember that we said on the technical part of the technical analysis, I'm sorry, we are watching about price movements, which means today, as we opened also a sell position on Euro USD, the desired profit was going to be in sell, and these are the levels that are crucial. But if the desired profit was going to move, the desired position was going to move in a wrong direction, this was going to be my losses, which means basically the strongest level of resistance I would have lost $730 or euros. This is a market opportunity for, let's say, for an example, if someone would invest $1,000 or above, so he cannot trade risky. My colleague, do you have anything to say?
Yes, of course. Like Alex said, what is important with your trading is to be a disciplined trader, to know how to manage your risks. We already explained you that on our platform, and the most important thing, as Alex said, is the information. You are going to have the technical analysis in front of you, and by simply watching, comparing, as we explained you, fundamental analysis, technical analysis, you can try to make some potential profits.
And I do believe that the most important part of this is having your own personal senior account manager who is going to be available for you 5 days a week, 10 hours a day. And what you simply need to do is not to lose your money, is just to communicate with him. Okay, this is going to conclude our presentation for now. Do you have any questions so far? Okay, you ask us a question. How does the webinar going to go on for? The webinar, the presentation itself just finished, and now we're open for questions.
Okay, so if there is no questions, that would be all. We hope that we were of some assistance for you. Okay, so
Okay, we have a
sorry,
question.
we have some questions. Okay, so one of our clients asked us for,
Can you not reserve?
can you not reserve to buy at a certain price?
Of course, you can open your trades instantly. You can open your trades instantly, but that doesn't mean that you're going to trade risky. Which is, there is one saying in Forex: it's a thin line between trading and gambling. If you open your trades instantly, close them again. That's one trading strategy that we call scalping or hedging. That means that first of all, it's going to be high cost for you, which means that you need to deposit initial deposit of minimum 10K and above. So that's for our client. We have another question. Thank you both. With the webinar be available anywhere? Yes, we are, as we always for you. Thank you for that. For the fundamental analysis, how do you know when to read it? My dear colleague David is going to explain that to you.
Okay, so this is to say our part of the job. Basically, you are going to have a senior account manager who is going to provide you with all the information from the market. I can bet on it that you didn't know, for example, that today it's going to be a GDP report that is coming from the United States. So this is the very important thing that you can look for yourself, but it's going to take you a lot of time. So in this way, you are having a senior account manager who is going to provide you with that information and with the precise analysis so that you know how does it has a potential to make you some profit. So another client of ours is asking, can a person do a $200 trade? Alex?
Well, yes, of course. But that means that your initial deposit on your trading account that you're gonna open with us is gonna be quite bigger. Like let's say, for an example, the 10K and above. That's because if you open $200 a trade, you need to always be on the safe side. That's called margin level, not to be in a stop out. Because the point of the fact of the matter over here is to make potential profits, not to lose money.
Okay, so just to mention to everyone who wants to take a look at this webinar one more time, we are going to provide you with this recording so that you can take a closer look whenever you want.
Okay, we're gonna wait for 5 more minutes for any more questions. After that, it's gonna be that. For that, you can expect a phone call from your account manager when you registered on a website. So, just a moment, we have a question. Yes, of course. The question was, is this webinar is going to be recorded and available always? Yes, it's going to be available. Also, we're going to do these webinars on weekly basis. One of our clients asked for start minimum deposit maximum what? That was the person that asked us if we can open $200 a trade. Thank you. We always say that because of the margin level, that's high risk. We always need to mention that if you're trading with leverage also, that's a two-edged sword. If you do $200 a trade, you need to have your initial deposit minimum at 10K. So be on the safe side. You're welcome.
Okay, so any other question? We are more than happy to help you. Like my colleague said, you are going to have this recording. One of our clients is asking, yes, of course, it's Cynthia. Yes, of course, Cynthia.
Cynthia asked, can she open an account with minimum of 200? Yes, she can, but also she would, yes, you can open an account with minimum of 200. That's not a problem. But also you're gonna need to use leverage. So everybody knows that we're reasonable people. We know the the deposit is, the higher the potential profit is gonna be. We have more questions. If I put a 200 trade on something, can I lose more than 200? If you lose a stop loss option, which is always recommended to do, you cannot. If you leave it open, yes, you can. From the 200 trade. It's going to be available on our website during the day, if not during the morning.
Yes, it's going to be available.
Okay, with this concludes our webinar. Thank you for attending. As I said, expect you already have your own account managers. They are available for you always for the question. You got their mails. We got yours also. So thank you for your time. See you next week at the same time.
Bye bye.
Bye bye.